Something strange is happening in the stock market right now, and most people don't even realize it. While headlines are full of fear, uncertainty, and confusion, a quiet opportunity is forming in the background. The kind of opportunity that years later, investors look back on and say, that was the moment I should have acted. But here's the problem. Most people are either ignoring it or worse, completely misreading it. They're sitting on the sidelines, waiting for things to feel safe again, waiting for perfect clarity, waiting for the market to calm down. And by the time that happens, the opportunity is already gone, because the truth is simple. The best buying opportunities never feel comfortable. They show up when fear is high, when prices are falling, and when confidence is low. And that's exactly where we are right now. Today, we're going to break down two stocks that are sitting right in the middle of this opportunity window. Two companies that have been heavily beaten down by the market, but underneath the surface, their businesses are still incredibly strong, their growth is still very real, and their current prices don't seem to match that reality at all. So stick with me, because once you see this clearly, you won't look at the market the same way again. Before we dive in, here's something important. If you want to become a smarter investor, especially during times like this, you have to learn how to separate noise from reality, because right now the noise is loud. Interest rates, global tensions, AI spending fears, market volatility, it's overwhelming. But underneath all of that, real businesses are still growing. And that brings us to the first company we need to talk about. Not the obvious one, but the one most people are underestimating. Let's start with Microsoft. Now, I know what you might be thinking. Microsoft? That's boring. Everyone already knows about it. It's too big to be a big opportunity. But just wait, because what's happening with Microsoft right now is anything but boring. In fact, it might be one of the most misunderstood situations in the entire market. Recently, Microsoft reported what many people are calling its worst quarter since 2008. That sounds scary. And the market reacted exactly how you would expect. The stock dropped hard. In fact, it's down more than 30% from its recent highs. Think about that for a second. One of the most powerful technology companies in the world down over 30%. Naturally, that makes people nervous. But here's where things get interesting. While the stock was falling, the business itself was still growing. Revenue increased by around 17% year over year. That's not weak, that's strong. And then there's Azure, Microsoft's cloud business. It grew close to 40%. Let that sink in. A company growing its cloud division at nearly 40%, and the stock is dropping like something is broken. That right there is the disconnect. The market is reacting to fear, but the fundamentals are telling a completely different story. And this is where real opportunities are created, because when price and reality move in opposite directions, smart investors start paying attention. Now, let's be clear. This isn't a situation where Microsoft is collapsing or losing its edge. This is a situation where a strong company got caught in a bigger storm, and that storm includes everything happening around us: rising interest rates, global uncertainty, heavy spending on AI, and investors becoming more cautious about risk. All of that combined pushed the stock down. But here's something most people forget. Storms don't last forever. And when they pass, the strongest companies don't just recover, they come back even stronger. And the investors who bought during the storm, they're usually the ones who benefit the most. But let's not ignore the concerns, because if you really want to understand an investment, you have to look at both sides. So what are people worried about? The first big concern is spending. Microsoft is pouring tens of billions of dollars into building AI infrastructure, data centers, advanced chips, massive computing power. And critics are saying that's too much, too fast. But think about this differently. What are they actually building? They're building the foundation of the AI future. And the companies that build that foundation don't just participate in the future, they control it. Cutting back now just to make short-term investors happy would actually be a huge mistake, because in tech, the winners are usually the ones who invest early and invest big. And Microsoft clearly understands that. Now, here's something I want you to think about. What if the market isn't punishing Microsoft because it's weak, but because it's investing aggressively for the future? And what if that creates an opportunity? Now let's go deeper, so because this is where the real story starts to unfold. At the center of everything happening with Microsoft right now is one word: AI. You've probably heard about it everywhere. AI is changing industries, transforming businesses, and creating entirely new markets. But here's what most people are missing. It's not just about who uses AI, it's about who owns the infrastructure behind it. And this is exactly where Microsoft is making one of the biggest bets in its history. Right now, Microsoft is integrating AI into almost everything it does. Word, Excel, Teams, Outlook, all of it is getting powered by something called Copilot. This is Microsoft's AI assistant. It helps write documents, analyze data, summarize meetings, and automate tasks. Basically, it turns everyday software into something much more powerful. But here's the part that confused investors. So far, adoption has been slower than expected. There are around 15 million paying Copilot users today. And Wall Street, they wanted more, they wanted faster growth. And when that didn't happen, they started to worry. But here's the perspective that changes everything. Microsoft has over 450 million commercial users across its ecosystem. So if 15 million people are using Copilot, that means only about 3% of users have adopted it so far. Now think about that. Is that a failure, or is that just the beginning? Because if that number grows from 3% to even 15%, the impact would be massive. We're talking about billions in additional revenue. And that's not some unrealistic dream. That's a very real possibility over time. So why is adoption still low? Simple. The technology is still being built out. AI at this scale requires enormous computing power. And right now, Microsoft is still expanding its infrastructure to support that demand. In other words, it's not that people don't want Copilot, it's that Microsoft is still building the system to deliver it at full strength. And as that system improves, so will the product. And as the product improves, more people will start using it. This is how adoption curves work. Slow at the beginning, then suddenly fast. Now let's talk about another concern: Azure growth. As we mentioned earlier, Azure is growing at nearly 40%. That's huge, but somehow it still wasn't enough for the market. Expectations were even higher, so investors reacted negatively. But here's what Microsoft actually said: demand for Azure is so strong, they can't even keep up with it. Let me say that again. They don't have enough capacity to meet demand. That's not a demand problem, that's a supply problem. And supply problems, they get solved. Microsoft is already investing heavily to expand its data centers and computing power. And when that expansion catches up, something very important happens. Growth accelerates again because now they can finally serve all that demand. This is one of the most misunderstood situations in the market right now. People see slowing growth expectations, but they don't see the hidden demand behind it. And that hidden demand, it's like a spring being compressed. At some point, it releases. Now, here's something that almost no one is talking about, but it might be one of the most important pieces of this entire story: the backlog. Microsoft currently has around $625 billion in contracted future revenue. Let that number sink in. This isn't speculation. This isn't maybe revenue. This is business that is already signed and already committed and waiting to be recognized over time. Think about what that means. Even if Microsoft stopped signing new deals tomorrow, they would still have hundreds of billions in revenue lined up. That kind of visibility is extremely rare, and it gives the company a very strong foundation. But it gets even better. Because Microsoft isn't just another tech company, it's deeply embedded into the global economy. Think about your own experience. When you think of email, you think of Outlook, spreadsheets, Excel, documents, Word, meetings, Teams. These tools are everywhere. Businesses rely on them every single day. And switching away from them, it's not easy. In fact, for many companies, it's almost impossible. It would cost too much, take too much time, and create too much disruption. This creates something very powerful: stickiness. Once companies are inside Microsoft's ecosystem, they tend to stay there, and that gives Microsoft a huge competitive advantage. Now let's bring this all together with one final piece: valuation. Because at the end of the day, price matters. Historically, Microsoft has traded at around 30 to 40 times earnings. That's what investors were willing to pay for its growth and stability. But today, That number has dropped significantly. The stock is now trading closer to around 20 times earnings and even lower when you look at future estimates, around 15 times forward earnings for a company like Microsoft. That's cheap. Not slightly discounted, historically cheap. And why is it cheap? Not because the business is weak, but because the market is scared. And this is where everything connects. When you find a company that is still growing, still dominant, still expanding into the future, but trading at a discounted price, that's not normal. That's an opportunity. Now, here's a question for you. Are you looking at Microsoft as a safe and boring stock? Or are you starting to see it as a misunderstood opportunity? Because what we just covered is only half the story. Now let's shift gears, because the second company on this list might surprise you. It's not as obvious as Microsoft. It doesn't get talked about as much in everyday conversations, but in many ways, it sits right at the center of one of the most important trends of the next decade. We're talking about Palo Alto Networks. And right now, just like Microsoft, this stock is down close to 30% from its recent highs. Again, the same story. The price has dropped, but the business itself, still strong, still growing, still expanding into the future. But before we even get into the company, you need to understand the bigger picture, because this isn't just about one stock. This is about an entire industry that is becoming more important every single year: cybersecurity. Now think about this for a second. Almost everything in the world today runs on digital systems: banks, hospitals, governments, businesses, even your personal data, and all of that needs to be protected because the threats are not slowing down and they're increasing. Here's something most people don't realize. Cybersecurity is not optional spending. Companies don't say, things are tight this year, let's cut security. That doesn't happen, because one serious breach can cost hundreds of millions of dollars, and sometimes even more in long-term damage. So what do companies do? They keep spending. In fact, during tough economic times, cyber threats often increase because attackers know organizations are distracted. That makes cybersecurity one of the most resilient sectors in the entire market. Now add AI into this mix, and things get even more interesting, because AI is changing cybersecurity on both sides. On one side, companies are using AI to detect threats faster and respond more effectively. But on the other side, attackers are also using AI to create smarter, more targeted, and more dangerous attacks. So what happens? The entire game levels up. Threats become more advanced, and defenses need to keep up. That creates a powerful cycle of demand, and companies that are leading in AI-powered security, they're in a very strong position. This is exactly where Palo Alto Networks comes in. But to really understand its advantage, you need to see the problem it's solving, because most companies today have a messy security setup. They're not using one system. They're using dozens, different tools, different vendors, different systems that don't always work well together. And all those gaps, they create vulnerabilities, which is exactly what attackers look for. Managing all of this is also expensive. It requires more staff, more time, more complexity, and even then, it's not perfect. So what did Palo Alto do? They took a different approach. Instead of being just another tool, they built a platform, a single integrated system that replaces multiple tools, everything working together, everything connected, everything powered by AI. Now here's where it gets powerful. When a company switches to this kind of platform, two big things happen. First, their security actually improves because there are fewer gaps. Everything is unified. Second, Palo Alto becomes their main provider. Instead of being one of many vendors, they become the vendor, which means they capture a much larger share of that company's budget. This creates something investors love: growth plus stability. The company grows because it's expanding its platform, and it stays stable because customers don't want to leave, because once everything is integrated, switching becomes very difficult. Now let's look at the numbers, because this is where things really start to make sense. Revenue is growing at around 15%. For a company at this size, that's strong. But here's something even more important. Their future revenue commitments, also known as remaining performance obligations, are around $16 billion and growing over 20% year over year. That tells you something very clear. Customers aren't just buying once, they're committing long term. Then there's their next generation security products. This is the newest part of the business, and it's growing the fastest, over 30% growth. That's where the future is. And that's where Palo Alto is focusing. So now you might be wondering, if everything looks this good, why is the stock down? And the answer is simple. The market is focused on the short term. Palo Alto is investing heavily right now. They're integrating acquisitions, expanding their platform, and structuring large deals. All of this can make short-term profits look messy. In a strong market, investors usually ignore that. They focus on future growth. But in a fearful market, they do the opposite. They focus on risks, they overreact, and they sell. And once again, like, that creates a gap between what the business is actually doing, and how the stock is being priced. And that gap is where opportunity lives. But here's the real question. What makes Palo Alto strong enough to win long term? Because in cybersecurity, competition is everywhere. New companies are always entering the space. So what gives Palo Alto an edge?